Ladies and gentlemen, in this video, I'm going to show you the one shift that you need that you can use to turn any strategy that you want to become long-term profitable. Whether it's a strategy that you're busy learning now, or if you want to learn a completely brand new strategy, or if you're already quite experienced with the strategy and you're not quite profitable yet. I'm going to show you one tweak that you need to make, the same tweak that I made to achieve a long-term profitable expectancy, such as what I'm showing you on the screen here in my public track record for 2025 at a total of about a 62% win rate, fixed 1 to 2 risk to reward, and about an average of a 45 total risk to reward gain. The interesting thing is, I've been trading the exact same strategy for about 6 years, but I only got profitable with it after 3 years. Trading the exact same thing, not changing anything. The difference is it's not in the strategy itself. And what exactly is this difference? Well, right here on the screen is the blueprint to making any strategy, ICT, EMAs. There's a million different things that you can trade, a million different strategies on YouTube. But it's not those actual strategies that are going to make you profitable. What's going to make you profitable is systemizing the way that you trade, removing all of the discretion from your trading, no longer letting our feelings make the decisions for us. Oh, today we have a beautiful 4-hour zone that we're going to buy from. Tomorrow we have a nice M15 zone that we're looking to buy from or sell from. And then the next day we have a beautiful daily fair value gap, okay? It's not in the concept or the strategy. We need to remove when we think we should trade with rules and criteria and repeat that same systematic process in the markets. Because once we have rules, we can now back those rules by data to prove that it's actually profitable, giving you all the confidence in the world approaching live price. 2 things I'm going to give you in today's video. I'm also going to discuss my exact strategy, my rules that I use to get about a 65% win rate over 40R in 2025 alone so far. Who exactly am I? My name is Jay. I'm the founder of Funded, a free trading community where I document my journey and share my live journal for various traders that want to learn on what it's like to collect data and build a track record. I'm a full-time personal equity trader. I trade prop firm accounts as well, and I'm also an investor capital trader that trades hedge fund capital. And how I got to this point today had nothing to do really with the strategy. It had to do with the concept and the blueprint that I've got on the screen over here. So essentially what this means is when price does this, we're going to do this. And only if price does this, we do this. Nothing else, nothing different. So once we have rules or a set of criteria, one of 2 things are going to happen. Price is going to print them. Yes. Great. You might have another set of criteria like I do. I have 2 sets of criteria that needs to print in alignment before I execute a trade. If those criteria print, great, we execute. If they don't, we do nothing, regardless of how many trades we get a day, a week, or even a month. You need to stop focusing on trying to trade every day or have a profit target every week or month. Rather, execute a profitable edge, and whatever that delivers, that delivers. Because when you're going after a specific profit target or a specific amount of trades a week, you're going into price, you're forcing out trades, you're hunting trades. That's when we start trading bullshit that's not a part of our rules. We're trading on emotions, where we think we should trade. We're seeing this today, something completely different tomorrow. We don't know if that way of trading is long-term profitable because there's no data that backs it. And the second thing about backtesting, if you're backtesting a strategy that's got very different rules, there's a lot of discretion, it's actually impossible to collect accurate data on that because it's going to be different every time. It's kind of like a chef that is making a completely or using a completely different recipe every time, expecting to make that same perfect dish over and over. The only way he's going to make that same perfect dish over and over is if he's using the same recipe with the same perfect ingredients. And it's the same thing I'm trying to explain to you here. Okay, let's dive into the charts. I'm going to go over my rule-based strategy. And if you guys want help with putting rules into your strategy, one thing you'll learn here is firstly, a ton of hidden gems in this video. And secondly, I'm not for or against any particular strategy. I don't have any interest in the ICT versus SMC versus retail feud. Honestly, it's a distraction and it's not the right thing to be focused on. You know, usually when you see in the comments of these videos, oh, ICT is everything, and it doesn't matter what you trade. What matters is if you have a systemized rule-based process that is backed by data. Like I said, that will give you the confidence going into live price. Okay, I'm going to open up my charts. I'm going to go over each and every one of my rules. So rule number one, I'm going to quickly open up my own checklist here. I believe it's this one. Here we go. Okay, we'll see over here. Let me just check all of these. 6 simple rules. Well, really 5 simple rules. Number one is my structure story on the 4-hour time frame. So my model is 4-hour time frame only. Very simple, very rule-based. There's no other time frames involved. What I will sometimes do is just look at the daily to get an idea and a bit more clarity on the 4-hour. Number one, criteria number one is my structure story. I've got my own structure indicator where I can mark out my structural lows. All right, simple. Pullback, break, structural strong low, break to the downside, pullback, weak lows, pullback, break, pullback. We're either going to continue short or we're going to shift bullish and then look at continuing with the bullish range. Okay, that's criteria number one, really done for me. The second criteria that I look for is a strong high or low, a previous low or high, such as this low that broke structure to the upside, to be swept. So either price must sweep past it, can candle close, but the key criteria after that is then an opposite side break of structure. After the sweep, I need to see then a new break to the upside. Very similarly to what we saw on my recent short trade on CAD JPY. We took out a previous strong high. We then created the new break of structure to the downside. Okay, so that's criteria 1, 2, and 3. Strong high sweep, break to the downside. Obviously, structure is already done for us. Criteria number 4 is I need to see a supply or demand zone above the 71 fib level. So I'm only looking at extreme supply or demand. Nothing in the middle of the leg towards equilibrium or towards discount or premium of the range. I'm looking at the extreme zones only. Order block, my rules for an order block is a zone that has created volume below that particular candle. This blue candle was the first candle that created immediate volume in this leg above the 71 level. So that's criteria 4 and 5, my only 5 criteria. Order block with volume above the 71 fib. From there, entry on the order block. So in this case, this was actually my refined wick zone. Entry on the wick zone above the fib. Stop at the 1 to 2 risk to reward. That's all I'm looking for. I don't care about long runners to the lows. That whole high risk to reward thing, it's great. It works for some. I am the kind of trader, I like a very high strike rate with a low risk to reward because I can confidently risk a lot more per trade. I know this because I used to be a very high RR trader, 20, 30, 50 R trades with a low win rate. I just personally get a lot more consistency, profits, and overall better performance trading this way. It's what my data is telling me, and it's also what my live journal is telling me. So once all my 5 criteria is there, coming back to this, my first set of criteria is met. Yes. Okay. My second set of criteria is fundamentals. I need fundamentals to align with my trade. So really, to put my strategy in a short, sweet, simple sentence for you to understand, I trade fundamentals, but I use supply and demand to time the fundamental entries with my rule-based technical strategy. So I trade both technicals, but I time fundamentals with my technicals. Okay, so limit set, but before I set this limit, there's a few things I need to see here. I know I've got a couple of tools here. It can look quite, maybe a bit messy, but it's actually very easy when you know what you're looking for. I'm going to break it down. So my first indicator here is my MM-funded institutional sentiment. So really, what this is telling me what the you could call it institutions or non-commercials is the right term, is doing in price. And this is the side of price I want to be on. So this indicator is a forecast. It's not relied on past market price action. Usually when you see price here going bullish, institutions are selling, we know that bearish volume needs to kick in. So all of this bearishness that we're seeing here is what was forecasted beforehand at this point in time. Way over here already, they started to short, and that's what we're seeing kick in now. Okay, see on the daily time frame, we're still bullish, and that's what is busy kicking in now. And we'll cover this long position now as well. Okay, so the first rule in my fundamentals, so now we're busy sitting at criteria set number 2, is in this pullback phase here. If I come back to just before tap in, right here, in this pullback phase, I need to see institutions shorting with my setup. This is the side of the market I want to be. Okay. Second script I've got over here is my retail sentiment. So this shows me what retail is doing, the non-reportables. So these are the guys that make up about 5% of the market, and they are usually 80% of the time on the wrong side of price. So I just use that as an idea to know that is not the side of price I want to be. So you'll see usually when institutions are buying, when retail is buying and institutions are selling, that's where they get liquidated. All right. And often if you just follow back in price here, institutions are buying at this point in time, retail is selling along with this. That buying volume from institution kicks in, retail is then liquidated. So that's just a good indication, fundamentally, of the side of price I don't want to be on. So firstly, we have a check. Institutions are bearish, retail's bullish, great. The second script I have is my valuation index. So this really compares price with the treasury bonds and the DXY and dollar cost averaging, and gives you a general valuation of the market, if the market is undervalued or overvalued. So I can see over here, we're coming quite into overvalue. And usually when price is very overvalued, we'll see some sort of pullback. Okay, so that's check, check, check. The third thing I look for really over here is, again, my institutional sentiment on the daily. So I can see we are bullish, so I can understand that if we go bearish here, this is most likely just a pullback in an overall higher time frame bullish market. Okay, so the fourth thing I look for is my MM-funded forecast tool. So this forecast tool is a seasonality tool. It really just shows me, based on the cycles and the season of price, an overall general idea of the direction of where price is due to go. I can see on the seasonality, we are due for quite a bit of a bearish run before we continue bullish. It's good. It's a nice confluence. The main thing for me are these two and COT reports, which I'm going to get to last year. So really, the valuation index and the seasonality forecast is just a confluence. The three that is a must-have for me is institutional sentiment, retail sentiment, and COT reports. So to really break down COT reports, much like people all over the world that make an income, you have to declare your money to your regulator in your particular country. America is SARS or IRS. My country is SARS, and we have to declare our income every year. Much like institutions, in this scenario, it's called non-commercials. Your commercials, which are your hedge funds, and those sort of guys, and then your retail traders are your non-reportables. So this gives me exactly what these guys are doing on this particular market. So I can see here right now, institutions are short on this market with over a net minus 130,000 net contracts on the Canadian dollar, expecting this market to weaken. Okay, so that is good. Remember, each of these contracts are worth tens of thousands of dollars. And then also, the extra plus is there are net 121,000 contracts long on the JPY. So when you are long on the JPY against the CAD, you are anticipating the Canadian dollar to weaken. Okay, so we can see institutions are bearish on this market. That is the side of price I want to be. As we play through, all alignment in this trade, obviously wicked in, wicked out in the same 4-hour candle. Really nice 4% gain there for me. Okay, looking at this long position, this was a half risk trade because it wasn't an all alignment trade. All right, pulling back into the setup. Okay, that's where we got tagged in. I can see the institution started to buy briefly and then really just flatlined on the 4-hour. But the confluence for me, they were very bullish on the daily. Yes, I understand. The COT is bearish. Firstly, strong low sweep, order block with volume, break to the upside, everything there. Okay, I can see on the valuation, we are quite undervalued on price. Retail started shorting into my setup, so we really had an alignment with the retail sentiment and the institutional sentiment. The only thing that was missing here, COT reports were bearish, so not as high probability of a position, but we ended up running here for a 2% gain. There we go, for that 2% gain, which I literally hit target about an hour and a bit ago. Here's another example of a position I recently took on Euro JPY. Apologies, Euro Swiss franc, for a break-even trade. Okay, so on Friday morning-ish is when I got tapped into this trade. And it was running nicely most of the day, but essentially what we had here, strong low sweep, break to the upside, pullback phase. There was a very nice short setup here as well, which I unfortunately missed at the time, as at that time I was just out and I couldn't set limits. Really how this trade looked like was we actually had a 4-hour strong high sweep, break to the downside. Here's our order block with volume right here. Okay, and obviously in terms of fundamentals, our base 5 criteria is there. In terms of technicals, in terms of fundamentals, really in this entire pullback, institutions were shorting hard. Retail really buying into the setup. Market was overvalued. Daily was also bearish. COT reports fairly balanced at 58 and 42% long. So that's why this market really has been going sideways the last while, is because overall institutions, which institutions are big for me in the COT reports because they are the trend makers. So this is your trend. And everything else aligned. So this was a very good trade. Obviously, this bearish volume, very nice. So in this pullback here, this bearish volume was forecasted, and that's now what we saw kicked into price after Trump announced his tariffs. Okay, coming into this long setup, as we pull back here, I could see strong buying volume coming into price. Retail shorting hard. So that's obviously the side of price I don't want to be. I want to be against them. Institutions buying, really nice. Only issue I had was dailies very bearish. COT reports, again, fairly balanced, but a little bit more bullish than bearish. Market was undervalued decently. So overall, it was a decent trade. I definitely anticipated a strong reaction of this demand. I ran to about 1.7R, set break even Friday night before the weekend, and obviously opened up Monday morning straight back at break even. 100% valid trade, and that just goes into my journal. Okay. One more trade I'm looking at. I took 2 trades on BTC USD, a short and a long position. So demand zone, we swept out a previous strong low that broke structure to the upside. Internally, this was a lot more of an aggressive internal setup, which is a part of my rules. I'm happy to take them, but if you're looking to trade this, you can use the structure indicator as is. Keep it nice and simple. Demand zone, immediate volume below the fib, all the 5 criteria is there. All right, in the pullback phase, I still have it marked out here. Strong buying volume coming from institutional sentiment. Retail shorting, so we're good. We're on the right side of price. We can anticipate that fundamental reaction to kick in. Market heavily undervalued at this demand zone. So we know when we're undervalued that we can anticipate it to revalue itself. At this point in time, seasonality as well, anticipating a bit of a bullish run on the daily. COT reports also fairly more long than what they are short. Okay, so yeah, COT reports very sideways. That's why we're seeing again a sideways market I do believe the last COT report did come out bullish on Bitcoin now on the 17th of March. So now we could see a little bit of bullish volume kicking in, maybe in the next couple of days. That is what I'm anticipating. So if we do get a nice long setup and the fundamentals are aligned with that, that is what I will be keen on. Anyways, back to this gold long setup. Once my fundamentals aligned, limit set, stop at the 1 to 2 risk to reward. A nice 4% gain there. Short setup as well. I can see as we hit take profit on BTC longs, have a look in the pullback phase before we got tapped in, what started happening on my institutional sentiment. Going short very nicely. Retail buying into my setup, not the side of price I want to be on. So good, we can see there's volume and hard selling power coming in from the non-commercials that we can expect to time that volume in our technical setup. Market nicely overvalued. Okay. Overall forecast at this time, seasonality forecast, which was about over here, anticipated a bit of a bearish run after our bullish run. COT reports, again, 51% long, 59% on the USD, sideways market. So COT reports is nothing definitive in terms of a trend at the moment. Overall, happy to take the trade. Fundamentals were there in terms of my sentiment. Nice 2R reaction. So another 4% gain there. Okay, so that was my Bitcoin this week. A couple other trades I've taken. I'll refer to my journal here. There's BTC I need to add. The other short I only got onto this evening, so I need to update everything here. Recently, I had a GBP NZD short, which was a loss. Let's go over that one. Where were we? GBP NZD. Here. Okay. So the short position I had, I believe, was over here. And the reason why this was actually a very poor setup is because of the fact that fundamentals actually completely unaligned. I, at the time, was also away. And I didn't have my laptop with me. And I left my limits in. So that's just my part, but it goes in the journal. I took it. It is what it is. Anyways, what we had here on GBP NZD was, I like the fact we actually just broke 4-hour structure, took out that 4-hour strong high that broke previous structure. We then broke structure to the downside, supply zone, volume, base criteria is there. Okay. Looking at fundamentals, what I initially saw was in this pullback phase from here to about here. Okay. Strong selling volume kicking in, retail's buying, market was really at the median, at average 50%. So it wasn't overvalued, wasn't undervalued. My forecast tool, anticipating a bit short, then going long, which is now what we're seeing. Okay. Daily time frame was very bullish as well, which was not great. COT was bullish as well. So this is a good example of a very, very poor setup. Fundamentally unaligned. On the 4-hour time frame, it aligned nicely. But as we approach tap-in the next day, have a look what institutions were doing. Right here. If we compare the candles in alignment with what was happening at that time, institutions were buying, retail was buying as well. Markets were actually more or less undervalued at the time, more undervalued than overvalued. So there was no reason for price at all to get a strong reaction off the supply zone, which then obviously melted straight out. And this was the entry right here, I believe. Stopped out there for a minus 2%. Okay, so that was that position. And as you can see, fundamentally just poorly aligned. So actually initially with this particular model I have made, again, through tons of losing, trial and error, retweaking, recollecting data on those tweaks. That's how I've got to the criteria today. This is actually where I started incorporating fundamentals. So without fundamentals, I had about a 58% win rate. With fundamentals so far, I'm at about a 73% win rate. Overall, for the year, at about a 62.22% win rate. So this simulation is just on a $100,000 balance for 1 hour, for 2 hour gain, 1% risk, 2% risk, and 0.5% risk. And some of my trades have been half. A lot of them have been 2%. Some have been 1%. So overall, I average my return to about a 43R gain. Okay. But at the end of the day, what you need to do is you need to take a checklist, create a checklist of your rules. All right, let's say you're trading EMA. EMA, crossover, once we get that engulf above, structure must be bullish, fundamentals must be bullish. We enter and have your risk management just as rule-based. I personally prefer fixed risk to reward, much more accurate when collecting data on that, as it gives you a lot more of an accurate representation of how it will perform in live price. Because again, if it's different R or different rules, it's a bit more difficult to collect data on that because it's different every time. So it's not really as accurate of a representation. When I talk about data, here's a great tool that you can use. I use FX Replay. These are all of my sessions. So my particular model is backed by about 200 years of data and over 5,000 trades. So yes, I know this is the higher time frame. I average about 6 to 15 positions a month on a busy month. I look at about 30 pairs. I average about 1 position per pair per month. Sometimes even every couple months, only 1 position on a pair. And how I've organized my trading view, very routine. I'm very disciplined with it. Every Sunday, I mark up all my symbols, put of what's interested to me that matches my rules in potential, the trades that match my fundamentals. I set my limits and goes into my limits section. And obviously when I'm in a trade, like with CAD JPY here, which is actually supposed to be tagged, this is now done. It goes back into the symbol list and rinse and repeat. And that's the same boring process that you've got to do over and over again if you want long-term results. Okay, because once you have those rules that are backed and proven by data, it doesn't actually matter how your trade plays out. And I'll explain why. Let's take the period of 2024 to 2025. All right, 24, the year of 2025, and then the end of the year here. Okay, within this year, you're going to have trades everywhere, all your valid setups. Okay, now this is the thing. We know we have a strategy that's backed, proven, and profitable. So to show you what that equity curve looks like, this is my higher time frame model for 2025 across all my pairs. So that equity curve from the start of 2019 to 2025, this is the equity curve I'm talking about. Now, each and every trade that happens here is a tiny, tiny speck in the long-term spectrum. Our job is to execute our rules when it presents itself. Once we've done that, we've won the trade. Regardless of how it plays out, we've done our job because we know we're executing a long-term profitable strategy. So yes, we can have periods. We have nice wins, couple losing streaks, maybe 4 or 5 losses in a row, nice wins, 5, 6 wins, 4 or 5 losses in a row. Okay. In that losing streak period, yeah, you may be a bit down for the month, but we know overall the strategy makes money. There's nothing to worry about. We just have to do our job and execute our rules that we know is profitable. Because as soon as we stray from that, we're executing, trying other things. Now we see a losing streak. Oh, the strategy doesn't work. You're not executing your edge. And this is why people strategy hop, is because they judge a strategy based on 4 or 5 trades. Maybe only 1 was a win, 4 was losses. But they haven't given it the time of day to test it thoroughly and collect thorough results on it. Maybe they just started the edge in the losing streak, but overall, it's actually an insane strategy. You don't know because you didn't give it the time of day. It's a very good saying. I or Warren Buffett, whoever else is millionaire traders, if they had to put their strategy on the front page of the Wall Street Journal, I promise you, more than half the people that trade that won't be profitable because it's not in the strategy itself. Even 100% rule-based strategy is subjective to each and every unique individual. You know, are you executing all the setups? Do you have rule-based risk management and risk appetite that suits you? There's all sorts of factors that come into this subjectiveness. And that's why I can give you the strategy. It doesn't mean you're going to be profitable. Just because I'm profitable with it doesn't mean you are. You need to go put in the hours. You need to go collect your own data. You need to go start practicing and seeing your own setups. I have a very good saying.
Whenever you learn a video on YouTube or a strategy on YouTube, you need to backtest 1,000 trades, 10, 20, 50 years, before even considering to trade any amount of capital with that strategy. And even then, so if your backtests are not profitable and you've executed that strategy to the T and you follow the rules perfectly, that's a good thing. That's a good thing. You don't have to blame yourself as a trader, because all we need to realize now is, okay, these rules are not printing results. We need to tweak. And once you make that tweak, you need to re-backtest those 1,000 trades and then compare the new data to the old data to determine if that is a viable change. Then you have full right to judge that strategy, not just on 3 or 4 trades. You need a huge data sample. Every decision that you make in this industry needs to be backed by data. If you want to change one time frame, one entry confirm, one whatever this, that, you need to re-backtest, redo 1,000 trades. And then when you want to change again, you need to re-backtest and redo 1,000 trades. Collecting data and backing your strategy by data needs to become a part of your routine. I still backtest nearly every night. Not every night, a couple times a week, many hours a week. Still to this day, nearly a decade into the industry. And that's what it takes. And it's that work that traders are not willing to put in. And it's that process that newer traders that come into this industry who have been given the complete wrong expectation of trading because of social media, that completely fail because they don't understand the process, because they're not taught properly. Learning how to trade in today's world is the biggest problem, not trading itself. It's very few people that I know that teach trading properly on YouTube. Only 1 or 2 people that have made a difference in people's lives. Besides that, I don't know or have not seen anybody else that teaches this correctly. Okay. Again, I'm no guru. I don't do the whole mentorship course thing. I do have a Discord community. You will need, if you want my TradingView fundamental scripts, you will need the paid version. I think it's $15 or $12 a month on the essential package, as you will need to be able to add at least 4 indicators to the chart. I will leave a link in the description for that as well. It's a lifetime license. There's no subscription or anything. That is the only paid aspect I have here. Okay, now you understand a little bit about how rules work, also about how fundamentals work, and how to line up your technical strategy with your fundamentals. Now's the time to go and put rules to your strategy, collect data on it. And once you start getting consistency with that, you will notice a big change, a big difference in your performance, and could be the click for you. You will get to a point, if you trade rules, you will click, because the beautiful thing about that is it's trading a set of rules. If it's not profitable, great, we retweak, we re-backtest. Still not profitable, great, we retweak, we re-backtest. That trial and error, you'll eventually click with something, and it's a matter of time. All right, guys, if you want to hop inside my community, I've got obviously my private course videos. Well, it's not actually private, it's just unlisted YouTube videos in there for you to learn each and every individual criteria, my fundamentals. I will leave the link. It's a direct invite link to my Discord server, and then I'll leave the link to my fundamentals website in the description down below. We'll see you guys on the inside. Take care.